I'm Jane. Welcome to the Attract Capital webinar series. I'm here today with Attract Capital CEO and founder, David Barnett.
Hi, everybody.
Today our webinar title is The Problem of Private Equity Investors with Little Operating Expertise. So Dave, this title suggests that some PE firms lack real operating expertise. Is this your view?
In some instances it is. A lot of private equity firms have great people with a lot of operating expertise, but a lot of private equity firms don't have operating expertise at the core of their management level in positions of authority. And I think it's because historically with private equity, they were deal makers. They were people that found deals and they put deals together. You didn't have to be an incredibly strong operating executive in order to be really good in the private equity business. But I think what I see is that a lot of private equity firms operate with too little real world operating executives in the core of their management team. They really rely more on MBA type theoretical analyses, which are a bit rigid and non-pragmatic. They have a lot of diligence specialists, so they cover the waterfront in terms of all the areas they look at, but they do it with specialists and they do it with checklists, and there's really no senior operating executive at a lot of these funds who basically can really break down and understand the greatness of the business that they're looking to make an investment in. So I would say, yes, I think a lot of them have a deficit with respect to operating experience.
So why is too little operating experience a problem? They seem to have made a lot of money in the past.
Well, they have made a lot of money in the past, but I think the problem it creates is that when you don't have real world experience, you don't know how to appreciate a business outside of a financial lens, and you really have a hard time grasping what's going on in terms of understanding the fundamentals of the business. It makes it harder for you to connect with the operating strengths of the business, and it also makes it hard for you to connect with the management of the business because you're looking at it one way, but they think about it a different way, and it just creates this bit of a gap in terms of understanding. And the view of being over analytical in a financial nature is that it overemphasizes the theoretical fundamentals of the business and it underemphasizes the importance of the people and the culture of the company. I've seen deals done where they've let the most talented management person at a company walk out the door because they didn't appreciate how important this person was to the growth of the business. And that happens more than it should, and it is because people don't have operating experience that are in the decision-making capacities of these firms.
Wow, thank you for sharing that. So tell us a little more. Why is this bad for companies?
Well, it's bad for the company that the private equity firm is going to make an investment in because this approach, it's sort of one of these things that can drive them crazy because they have this view that they developed during due diligence. They then foist it on the management team, and their view may not be accepted by the senior members of the management team. So you have this conflict between what the private equity investors think is the best thing about the business and what the senior managers actually know intuitively, because they've been doing it for decades, what the best thing about the business is. And it creates misalignment and conflict. And I think also because a lot of operating executives at these companies that get invested in, they are super talented people and they've built businesses with their entrepreneurial vision and their drive. And frankly, they really don't like being told by high-level theoretical MBA types how to run their business. They just don't like it because they don't think the person is meeting them at the level that they're at. So I think in many ways, while I think PE firms are well-intentioned and they want to do the right thing, I think a lot of times the way in which they go at these, the due diligence of these deals, it disturbs the culture and it drives good people away.
And in these cases, then, what can companies do?
So I think what companies do is they have to be really savvy about the private equity firms that they're choosing to work with. And I think one of the things they can do is look for private equity firms that have an operating culture. And those firms are usually come from people that have been very successful building businesses, selling them, and starting a fund. You could usually find more operating expertise DNA at those firms that have an operating experience culture. I think you can also look for who are the decision makers and the people in authority at those firms. You want to look for people that have gray hair, that have been through the cycle, and they've been through a lot of different types of deals. And I also think you want to be a little skeptical of people that want to make easy comparisons between, oh, your company is just like this other company we have in this portfolio, or this other company we have in the portfolio, because no two companies are really alike. You might be in the same sector, but you're going to be very different in terms of your operations and your product set. So I think it just comes down to, I think private equity groups need to elevate and put more of a premium on having super experienced operating executives at positions of authority. And then I think it would mean much more value for the companies that they invest in.
Thank you, that's great. Well, there you have it. Thank you for tuning in. We look forward to seeing you next time.